it's a slow week. The markets can go up, they can go down. I don't like trading into it. I like, the year's over as far as I'm concerned. When I was in the industry and we were, self-directed brokerage, so people would call in. The call volumes went way low. Everyone was gone.
Yeah.
And it's like they say, it's a world holiday. Christmas isn't just a U.S. holiday; it's the world.
Right.
So everybody's gone and everybody's with family, and only the hardcores are still around trying to trying to swing trade or invest or move things around. But the institutions, they've done all their adjusting, and pretty much, they're gone, and they'll come back and they'll readjust on the beginning of the year and off we go again. So,
Yeah.
that's the way I look at it. I'm not going to plan on doing much of anything for as far as trading or anything, but, just planning, what am I going to do next year? What am I looking at? You know, but
I think I think next year is going to be awfully interesting. Um, you know, you I hear, like I sent you that text. I hope it really doesn't go down 60% next year, but it's sort of like how misleading news media can be. You know, they don't come in and say everybody has gone on vacation because it's the end of the year when it comes to institutional traders. They don't look at the real data and the really what's going on. And they're just using this, oh, the Russell 2000 is up. It's been up in the last couple of, weeks or whatever. The Dow is up, it's at an all-time high. The S&P is what, near all-time high. It's sort of like, well, why? Let's look at the mechanics of this and let's look at the reality. And the reality is there's nothing to support it, you know?
well, the catalyst was the Fed. Okay, and
Yeah.
the FOMC press conference where Powell came out of nowhere and was talking about rate cuts. All of a sudden, yeah, we're talking about rate cuts, and the market went nuts. Rate cuts.
Yeah.
Well, I mean, you and I both looked at charts, and markets go up right after the idea of a rate cut, and we haven't had one yet. And
Right.
so markets grab this euphoria and they move up, and then Sunday over the weekend and Monday we have all these Fed chairs, not chairs but governors and presidents come out and say, no, no, we never talked about any of that. You can't just make a decision based on the dot plots and all that because the market took off. So what's that mean? People feel richer. I'm going to go out and spend more.
Right.
Inflation's going to go up. So they shoot themselves in the foot. So you've got to think about what was in Powell's head. Why would he come out all of a sudden and talk about rate cuts right before the end of the year? And I think there's a lot of theories out there, but I think it has to do with the banking system. Okay, and if we look at last March when Silicon Valley Bank went down, they put together this um, bank term funding program. They call it the BTFP, and it's an emergency lending program. And it was
Yeah.
launched in March. It provides liquidity to U.S. depository institutions like banks. So what they would do is they had their collateral, which was the bonds at 2% that were underwater, and they use that as collateral to go to this new program, the Fed, the Bank Term Funding Program,
Yeah.
and said, okay, here is my 30-year bond, let's just say, as an example, at a discounted 2.2% interest rate. It's underwater. And the Fed and this BTFP FP put gave them par. So they got full value of that
Yeah.
as their loan. But even though that the underlying asset was lower than that. So
Right.
that's like during a housing crisis where your house was worth $1 million and now it's only worth $500,000, but you still want 100,000, you want $1 million for it on the sale,
Yeah.
and someone gives it to you and says, okay, but you got to come pay that back. So I'm looking at
All right, I'm gonna put
my
the this chart up on it. I think I have the right one.
I've got one too. It's the Fed one. Yep.
Is this it?
That's definitely one of them. Yep. Yep, that's it. Yep.
Yeah.
That's exactly what it is. And you're seeing it go up.
Yeah.
Okay.
So that was
And
March. This is March 8th, I guess, when it was just before it was introduced. That's March 15th. And we're talking millions when you look at that number,
which is billions.
which is billions.
Yeah.
So it's the millions times the number. And you look at April 5th of this year, you had a spike, it dropped off a little bit. And then back in May, it started continuing that rise higher. And then here's interesting is it's gone basically semi sideways since what, August?
Yep.
So that means the banks are bringing their securities to this window to get cash. And then all of a sudden, around the 1st, 8th of November, the thing starts inching up. And then on the 29th, it basically starts going higher. So, and that brings you to the 13th.
Well, what happened in November was you started seeing yields come down. So
Yeah.
then Powell came out, with the banger on the FOMC. And so I did a little research, and it's interesting if I can share a screen.
Yeah.
And I was thinking, wow, these banks are in trouble, because they're putting more, we're seeing a spike in this program, and they
Yeah.
must be in trouble. But I did a little research.
Did it do it?
Yep. And I found this article it was in Quiver Quant, and you can find, it's the beauty of what we have here is you can find articles if you need it. And
Yeah.
so basically, oh, here we go. Sorry, I have to go back.
It's all right.
My picture was in the way. So this article talks about Fed Bank Term Funding Program gains traction amid rate cut expectations. So it's kind of interesting. We'll just go through a little bit of it.
Yeah.
So the Federal Reserve Bank Term Funding Program, initially launched in March to support banks during a banking crisis, has seen renewed interest due to the central bank's recent dovish pivot and growing expectations of interest rate cuts. The BTFP, designed to provide short-term loans to banks and credit unions against treasuries and agency debt as collateral, has become increasingly attractive as a prospect of rate cuts in 2024 makes its rates more competitive. And I'm like, well, that's pretty interesting. So if you go down and look at it, the usage of this program, which allows borrowing for up to 1 year, and it expires in March of this year. So you can still borrow right now for a whole year at a rate slightly above the 1 year overnight index swap rate. And that's important right there, has surged. And that's what we just saw in your chart. The facility's appeal increased as the Fed swap pricing indicated about 140 basis points of rate cuts by December of next year. In contrast to September, when the rate was around 5.61%, it now stands at a more favorable 4.96%. This rate is lower than the Fed's discount window, and we can talk about that. That's a different area where you can go borrow a short term overnight. That's the Fed discount window of 5.5%, leading to a spike in the BTFP borrowing from 100 billion in June to 124 billion in mid-December. So basically, what they're doing is they're getting a better deal by using this program that was supposed to help them with liquidity. But actually, they're turning it around, and the banks are actually benefiting by this. So if you look at it, here it is again. The Fed's Bank Term Funding Program, initially conceived as a lifeline during the banking crisis, has unexpectedly become a prime borrowing option for banks thanks to a dovish central bank signals. With rate cuts on the horizon, this BTFP's fixed rate suddenly looks attractive, driving record uses and sparking arbitrage opportunities. This unforeseen twist adds another layer to the evolving narrative surrounding the Fed's monetary policy and its impact on financial institutions. So now it's arbitrage. So this program offers a 1 year loan at a rate tied to the 1 year overnight index swap rate plus 10 basis point, currently lower than the discount window's 5.5%. As markets bet for rate cuts by the end of next year, this appeal grows with usage hitting a record $124 billion. So what they're doing is they're making money off this by having a lower lending rate. So that's why you're seeing it And then you look on the other side where you have the discount window and, and the repo market. I think that if I remember right, Trent, that's down to about $1 trillion now, and it's lowering. Well, where's the
But
money going? Well, it's going into these programs here, and it's going into buying treasuries.
so the Fed is, the banks are buying the treasuries with this money.
Well, and yeah, there we'll go and get a lower loan rate now
Yeah.
with this program. This is how I see it. Then they can get by borrowing overnight on the
Fed
Fed's discount window.
window. Yeah.
Yep. And so that's what they're doing. So, it says the structure, which allows prepayment or refinancing without penalty, no penalties, offers
Yeah.
banks flexibility and an advantageous position, especially with a downward sloping yield curve. This setup enables banks to profit from the difference between the BTFP rates and the higher rates on short-term liabilities. Furthermore, banks can leverage an arbitrage opportunity by borrowing at the BTFP rate and then depositing these funds in their Fed accounts to earn interest on the reserve balances, currently 5.4%. So they're borrowing at a lower rate in this program, and then they're putting it back into Fed accounts and getting more. So they're making more money. So here are the banks, in my opinion, taking advantage of something that was supposed to help them, and what they're doing on top of is making money off of it.
Well, let me just play this idea out. You go borrow this money, you go buy the 10, 30-year treasury, or the or just whatever a month ago. Okay. So you're probably 10-year, you're probably at 4.5, 4.75, maybe.
Yeah.
You buy in with this borrowed money. Everybody else starts doing it. I mean, think about Goldman Sachs as a bank.
Mm-hmm.
How much do you think they rolled up and borrowed? And then they buy those treasuries, they drive down the 10-year, I think is below 3.9 now.
Yep.
So that value of that treasury goes up. At some point, they're going to tap out on how much they can take. And then at that point, 10-year is down 3.5. They sell it, repay their debt, and they just made a chunk of money.
Yep.
And then they go put it in the whatever that is, the 5.4% rate, and get that.
Yep.
What a trade.
Then they give the retail investor, 0.01% on their savings account.
Exactly.
So yeah,
I mean, you think about
and then if something happens to those banks, they'll be the first in line to want a bailout.
Right.
Yep.
Right. Well, you think about
But you got to remember the Fed is owned mostly by the banks. The banks are the shareholders, the big banks. And so the decisions made by the Fed are not, in my opinion, for us or for the government. There's a lot of Jamie Dimon probably whipping up the phone and saying, "Hey, guys, we could use some help over here," because it's so strange. And again, you can call it conspiracy theory, but it's interesting that all of a sudden we had this whip around right before Christmas and right before things are going to be due in March.
Well, I'll be interested to see how that number goes up. So that's a weekly number that it lists. So the last one was on the 13th, which was a week ago. Today I'll be curious to what it'll be today. Tonight after close, it'll update. I would not be surprised if you see this continue to accelerate.
Oh, I would agree.
The
Because
question I have is
that window's closing in March, allegedly.
right.
And so they're going to accelerate that, and when you're talking, a point or two, that doesn't seem like a lot for the average retail person with $10,000. But when you're talking billions of dollars,
Trillions.
that's a lot.
Yeah.
And trillions. Yeah.
Well, you think about who became a bank during the financial crisis. Goldman, Morgan Stanley, Merrill Lynch in a way because they got acquired by Bank of America. You got all the prime dealers. My question is, did my bank, Regions Bank, partake in this? Are they doing the same thing? I mean, honestly, in a way, I hope they are, because it keeps them liquid. If not, but also, what about the real small bank, the hometown bank? Do they have that capability? Probably not.
Probably not. I'm not a banker, but it's, I, you know, I believe that the future holds fewer banks and larger big banks.
Yeah. Well, and I think that's,
But
once again, it's this divide between the haves and have-nots, and this is where your small town bank, it goes away eventually, and everything
absolutely
becomes 12 different banks.
right.
Crazy. I mean, here's a program that was supposed to be for the better good, and create liquidity for banks, and then you got probably a bunch of guys who just said, we're gonna make some money off our
Right,
government today.
right. And we'll see if they even close that window, that new program down. They may extend it, and it could go on for a while. Man,
Yeah.
what a deal. I wish that you and I and the rest of, the, the, the subscribers could do the same thing.
Yeah. Well, see, that's
We'd
really the
probably,
unfortunate part about this is you can't.
no,
No. I've got a friend who's partners in a bank, and it's a small bank, very small bank. And I wonder if he has access to something like this. And I mean, honestly, I wonder if they even know what, like, the guys like Goldman and Morgan are doing, or what could be doing. Who know? I mean, maybe, it's not happening, but sure as hell, if I ran a bank that big, we're gonna make some money off this borrowed money.
yeah.
you know. Um, I think that's the thing is, like, things like this that most people don't even know about, that will eventually trickle down and affect the average person's life in some way or another. You know,
Yep.
CNBC's not talking about it. Bloomberg's not
No.
talking about it.
Well,
Um,
they're all part of the bigger picture of the whole system,
yeah,
and CNBC, and in my opinion, and Bloomberg, and those are there to promote, the customers that pay their bills, which are financial institutions,
yeah,
and the talking heads that they come in that make stock recommendations that are in their portfolio.
yeah.
Um, so I mean, if you think that your financial advisor and or your bank is really looking out for your best interest, you may want to
Hey,
rethink that.